Welcome to The Explainer. Today, we're breaking down one of the most powerful concepts in all of finance, something called the time value of money. Now, it sounds complicated, but it's actually a pretty simple idea that once you really get it, is going to change how you think about everything, from your personal savings to massive business decisions.
At its very core, the whole concept boils down to this one simple sentence. A rupee today is worth more than a rupee tomorrow. I mean, it seems obvious, right? But believe it or not, this single idea is the foundation for pretty much all of modern finance. So let's dig into why that is.
So what does this actually mean in practice? Well, it's all about potential. See, the money you have in your hand right now can be put to work. You can invest it, let it earn interest, start something with it. It has earning capacity from this very second. But money you're just promised in the future? Well, that's all it is, a promise. It isn't working for you yet.
To really get a handle on this, let's look at how finance pros use what's basically a financial time machine. And we're going to start by pointing that time machine toward the future.
This is something called future value, or FV for short. It's the tool that lets us answer that classic question. Hey, if I invest this chunk of money today, what's it going to grow into down the road? That little formula you see there is what powers the whole calculation.
Now, you do not need to be a math genius to figure this out, I promise. The secret is using a simple tool that basically gives you a growth multiplier for your money. Let's see exactly how that works.
Okay, so this table might look a little intimidating at first glance, but it's really just a cheat sheet. It's filled with all those growth multipliers we were just talking about. You can see how it's set up, right? You've got the interest rates running down the side and the number of years going across the top.
Finding the right number is just a simple three-step process. You find your rate, you find your time, and you see where they cross. It's kind of like a game of Battleship, but for your money.
So let's try a quick example. Say we want to find the factor for a 10% return over 3 years. We just follow the 10% row across until we hit the 3-year column, and boom, there's our factor, 1.3310. Simple as that. So what this tells us is that every single rupee you invest would grow to about 1.33 rupees in those 3 years.
Okay, but what if we want to flip our time machine into reverse? Well, that's called present value, or PV. Instead of asking what today's money is worth in the future, it asks a different question. What is a future pile of cash worth to me right now? This is so important for figuring out stuff like lottery winnings or big business deals.
Now, so far, we've only been talking about single lump sums of money. But what about money that's paid or received on a regular schedule, like a monthly payment? This is where a concept called an annuity comes in. And trust me, you probably deal with these all the time without even realizing it.
And yeah, you've definitely seen these before. That monthly SIP you contribute to, a home loan EMI, even your rent or your insurance payments. All of these are technically annuities. They're a huge part of everyday financial life for almost everyone.
Okay, now let's see where the time value of money really, and I mean really, comes to life. We're going to set up a classic investing showdown that perfectly shows off the incredible power of time. Let's meet our two competitors.
On one side, we have the early saver. They invest 10,000 rupees a year, but only for the first 10 years, so a total of 1 lakh invested. On the other side is the late saver. They wait 10 years to start, but then they invest double the amount, 20,000 a year, for the next 10 years. That's 2 lakh in total. So who do you think ends up with more money after 30 years?
All right, let's look at the results. After 30 years, our early saver, who only put in 1 lakh rupees total, ends up with over 10 lakh. That is a pretty incredible return on their money.
But what about our late saver? Well, despite investing a total of 2 lakh rupees, that's double what the early saver put in, they finish with way less, only about 8.27 lakh.
I mean, when you see it on a chart like this, the result is just stunning. The early saver wins. And it's not even close, even though they invested way less money. So the big question is, how is this even possible?
And the reason why is laid out perfectly right here on this timeline. You see, the early saver's money, even though it was a smaller amount, had a massive head start. It got a full 20 years of uninterrupted growth, just compounding away. The late saver's much bigger investment, it only had 10 years to work its magic.
So here's the crucial takeaway. In that whole formula for financial growth, time is by far the most powerful variable. It's the exponent in the equation, which means it creates explosive exponential growth. It's what allows the magic of compounding to really, truly work.
And that brings us to the single most important lesson from this entire explainer.
The story of our two savers isn't just some made-up example. It reveals a fundamental truth about how wealth is built.
You know, the sooner you start, even if it's with really small amounts, the more you put this incredible exponential force to work for you. Time is the one asset that you can't buy more of, but you can choose to start using it wisely, right now.
So the real takeaway today isn't some number from a table. It's a call to action. You now understand that time is your greatest financial asset. The only question left is, what are you going to do with it?